I'm David Kraus, the instructor for the course Introduction to Applied Investing. This is lesson 4.1, Fundamental Stock Analysis. While we've just finished discussing the importance of owning a diversified portfolio made up of many different securities, it's still important to understand what constitutes a good individual common stock. And that's what we discuss in this lesson. Throughout this course, we've made various references to fundamental analysis, which is the systematic method of common stock evaluation that involves an attempt to measure the true or intrinsic value of an investment. A stock analyst employing fundamental analysis attempts to research literally everything that can affect the value of a firm's common stock, including macroeconomic factors like the overall economy and the current conditions within an industry, and all relevant company-specific information like a firm's financial condition and the core competencies of its management. The ultimate goal of conducting fundamental analysis is to generate a valuation, which is essentially a number that the investor believes the stock should sell for. By comparing this price with the security's current common stock price, the analyst can determine whether or not the stock should be purchased. Obviously, investors want to buy undervalued securities so that they can earn higher rates of return. My conversion to fundamental analysis came after I read about Warren Buffett in John Train's 1980 book, The Money Masters. This method of security analysis assumes that markets at times can be inefficient and that the potential to identify mispriced securities exists. Train's book provides a concise description of Buffett's investment approach, which he described as follows. The essence of Buffett's thinking is that the business world is divided into a tiny number of wonderful businesses that are well worth investing in at the right price, and that there are a large number of bad or mediocre businesses that are not attractive as long-term investments. In those rare occasions when a wonderful business is on sale, in other words, it's priced below its intrinsic value, Buffett buys boldly, paying little attention to what others are doing or saying about the economy or the stock market. Buffett's criteria for a wonderful business is no secret. It includes the following. The business has to have a good return on capital without a lot of debt. It must be in an understandable line of business. The profits must lead to positive cash flow. The firm should have a strong business franchise and therefore the freedom to control their product's pricing. The firm should be fairly easy to run. The future earnings should be highly predictable, and the management team must be shareholder friendly. That's the list. Looks pretty easy, doesn't it? Well, the truth is that selecting individual stocks via fundamental analysis is hard work. It requires discipline and a considerable amount of time and thought, and there are really no shortcuts to good analysis. Can anyone be a good fundamental analyst? Unfortunately, the answer is no, since you need to possess a thorough understanding of business and have a good comprehension of accounting and finance. So what's been Buffett's true strength over the years? It's been his knowledge of competitive strategy, which is a firm's long-term action plan to achieve a competitive advantage over its rivals. Another way to say this is that Buffett thinks like a business owner and not just a shareholder. He buys for the long term, and he wants to own companies that have successful, long-standing competitive strategies. Some people have described this approach as finding firms with strong economic moats. This is a term that is used to describe a firm's competitive advantage, and it can be thought of in the same way that a moat around a medieval castle kept invaders at bay. Economic moats can keep competitors from attacking a firm's profits. Let's look a little more closely at this. In a competitive market economy, successful, in other words, profitable businesses generally attract more competition. And because investment capital seeks out the highest rates of return, new firms will enter profitable markets. As a result, if a profitable business does not have an economic moat, they will see their returns regress to the mean. And they will soon become a mediocre firm earning an average rate of return. Joseph Schumpeter, the Austrian economist, called this creative destruction. And it does seem to be the norm. A strong economic moat can keep competitors at bay, and while maybe not forever, the moat can hold long enough for them to continue to earn high rates of return. And these are the types of firms that Buffett has sought out and invested in successfully over the years. I've had the opportunity, along with my students, to hear Mr. Buffett speak in Omaha, Nebraska, his hometown and headquarters of his firm, Berkshire Hathaway. And the one thing that really struck me was what he said about his commitment to research and reading. He says that he goes into the office early and reads uninterrupted for most mornings, a good 4 or 5 hours. He reads 10K and 10Q reports. In addition to also staying current on world economic news, he says he loves to read about business. As one of the richest men in the world, he could be doing anything he wants to do anywhere on the planet. But instead, he's in Omaha at 7 o'clock in the morning poring over financial statements. That's his secret to success. He has a deep business knowledge and he works at it. No tweets or text messages are likely to reveal an economic moat. You should read Warren Buffett's annual reports for his firm, Berkshire Hathaway. They're amazing. I believe that you'll probably learn more about analyzing a company by reading past issues of these reports than you will by reading most of the books written on stock investing. One last thing. Look at this picture of Warren Buffett at his desk. What do you see on the desk? Magazines, newspapers, financial reports, and a phone. What don't you see? There are no stock tickers, no Bloomberg terminals or smartphones. There isn't even a personal computer. It's been estimated that Buffett and his firm have created over $700 billion of value for Berkshire shareholders from this desk over the last 50 years. And he did it without the advanced technology most investors think they have to have today. So this might be the major takeaway from this lesson. To be a great fundamental analyst, you need more than massive amounts of information. You need knowledge and dedication.